Good day to you folks. I would like to do a summary of accounting for impairment losses, or how to do accounting for possible impairment losses with you. So I think it's kind of complicated, so I'd just like to review it for a minute. I have a goal, and the goal is to calculate or to review the gap for impairment losses on property, plant, and equipment and finite life intangibles first. Review gap for impairment losses on infinite life intangibles second. And third, review the gap for impairment losses on goodwill. So, we'll start then with impairment losses on property, plant, and equipment and finite life intangibles. Do facts and circumstances suggest a permanent and significant decline in value of an asset, that is, property, plant, and equipment, or finite life intangible? If the answer to that question is no, then do nothing. If the answer to that question is yes, the recoverability test has you compare book value to fair value. Oops, not fair value. Sorry about that. I was about to screw up my own summary. Compare book value to the future value of undiscounted cash flows. If book value is greater than undiscounted cash flows, you get to, voila, do nothing. If book value is less than undiscounted cash flows, you get to calculate the loss. How do you calculate the loss? Let's summarize that too. To calculate the loss, you take book value and subtract the fair value of your asset. If you don't know the fair value, but you're discounting the future cash flows, and you do discount them when you're on this step, you can discount your future cash flows and compare that to book value, but it's the discounted cash flows, not the undiscounted cash flows, and it leads to a journal entry where you recognize a loss and you credit the related asset that we've been looking at. So that's a summary of how to review the gap for property, plant, and equipment and finite life intangibles. Let's move on to infinite life intangibles. Reviewing the gap for impairment losses for indefinite life intangibles is a one-step process, not a two. And you must do it annually. So you have a related asset and you test it annually. You compare the book value of your asset with the fair value of your asset. You'll never be using estimated cash flows here because you have an indefinite life. You can't determine how long it's going to live, so you won't know an N in your discounting functions. If book value is greater than fair value, you get it, do nothing because no loss is indicated. However, if book value is less than fair value, you need to record a loss. And the calculation of that loss is easy. You've just done it. When you calculated the first step, you take the book value of the asset and subtract the fair value of the asset, and that equals a loss, which would lead to an entry where you debit a loss and credit the related asset account. That sums it up for infinite life intangibles, and really it's the easiest of the three we looked at because it's just a one-step process. Let's review impairment losses for goodwill now. Goodwill's a little trickier because the impairment loss doesn't tie to a particular asset. It ties to the value of an entire entity. If facts and circumstances suggest a permanent, do facts and circumstances, we should say, suggest a permanent and significant decline in value of this entity? If the answer is no, then you Yay, do my favorite. Nothing. But if the answer to this is yes, we have a two-step process to go through. The impairment test has you compare the book value of the net assets with the fair value of the entire entity. If the book value of net assets is greater than the fair value of the entity, you get to, oh voila, do nothing. If the book value of your net assets is less than the fair value of your entity, you get to calculate a loss. And how do you calculate that loss? Let's review that. Calculation of the loss. The calculation of loss has you start with the fair value of the net assets of the entire entity. You spelled that wrong. And subtract from that the fair value of the net assets, excluding the fair value of goodwill. So not only do you have to come up with the fair value of the net assets of the entity, you have to, in total, you have to come up with the fair value of the net assets, not including goodwill. That gives you the implied fair market value of the goodwill that remains. Let me restate that. The fair value of net assets of the entity minus the value of the net assets. And you don't put a value on goodwill, you just add up the fair value of the net assets and you exclude goodwill. When you subtract one from the other, it gives you the implied fair value of the goodwill. So it's not really a calculated number until this point. Once you have the implied value of the goodwill, you compare that to the book value of your goodwill, and that gives you your impairment loss. And so you're going to debit the loss and credit goodwill. This is how goodwill gets written off. It does not get amortized. It gets written off in big chunks. Quick review, take the fair value of the net assets of the entity in total. Then take the fair value of the net assets excluding goodwill, and that gives you the implied value of the remaining goodwill. Both of those are difficult numbers to come up with. Thank goodness you only have to do this with facts and circumstance suggest. Take the implied value of that goodwill and subtract the book value of the goodwill, which will be left where you recorded it at, since we don't amortize goodwill. And the difference is an impairment loss, which you record with that as an entry. Hopefully the comparison of these three methods has helped you get a handle on how to do impairment accounting for all three types of assets. I do struggle with that word, don't I? Thanks for joining me. Talk to you soon.